Your big bank is paying you $1 a year on $10,000 in savings. $1. Meanwhile, the best high-interest savings accounts in Canada right now are paying 30 times that on the exact same cash with the same deposit insurance and zero monthly fees. Let's fix that. A high-interest savings account, or HISA, is exactly what it sounds like, a savings account that pays a meaningfully higher interest rate than what the big banks offer. Most major Canadian banks pay somewhere between 0.01% and 0.05% on a standard savings account. The best HIAs in 2026 are paying around 1.5%, and in a TFSA, that interest is completely tax-free. And that gap is not small. On a $20,000 emergency fund, the math says a standard account earns you about $10 a year. A 1.5% HISA earns you $300. Same money, same CDIC deposit insurance protection, totally different outcome. According to the Financial Consumer Agency of Canada, most Canadians still hold the majority of their liquid savings at their primary bank, which means most people are quietly leaving hundreds of dollars on the table every single year. Let's talk about EQ Bank, because it comes up first for a reason. EQ Bank is a fully digital bank, no physical branches, and that's exactly why their rates are so competitive. Without the overhead of thousands of branch locations, they pass those savings back to you in the form of higher interest. According to EQ Bank's published rates, their TFSA savings account currently offers one of the top rates in Canada for a simple, no-risk savings product. No monthly fees, no minimum balance, CDIC insured up to $100,000, and critically, it's TFSA eligible, meaning the interest you earn is completely tax-free. For a freelancer or self-employed person sitting on a cash cushion between contracts, that tax-free compounding on even a $15,000 buffer adds up fast. At 1.5%, that's $225 a year you're not handing to the CRA, every dollar tax-free. EQ Bank also offers a notice savings account if you want to lock in a slightly higher rate in exchange for a short notice period before withdrawal. Worth knowing if your cash buffer is stable. Wealthsimple is the other name you need to know. Most people think of Wealthsimple as an investing platform, and it is, but their cash account and TFSA savings option are genuinely competitive in the HISA space. Wealthsimple Cash functions like a hybrid checking and savings account. You get a Visa card, peer-to-peer transfers, and a solid interest rate, all with no monthly fees. Their premium and generation tiers, which kick in at higher deposit thresholds, offer boosted rates, though the base rate is competitive for most people. The key difference from EQ Bank? Wealthsimple is also where you'll invest. So if you're already holding your index fund ETFs in a Wealthsimple TFSA, keeping your cash buffer there too means everything lives in one dashboard. That's not a small thing. Most people don't realize that account friction is a real reason people fail to move money between institutions and end up just leaving it at their big bank. One ecosystem, less friction, better habits. According to Wealthsimple's published account terms, deposits are CDIC insured, the same protection you'd get at any major Canadian bank. Here's how to actually compare these accounts, because the advertised rate is not always the whole story. Watch for promotional rates. Some banks offer a high teaser rate for the first 90 days, then quietly drop to something much lower. Always check the ongoing rate, not the promo. Second, check whether the rate is tiered. Some accounts pay their top rate only on balances above a certain threshold, say $10,000 or $50,000. If your balance is below that, you may be getting a lower rate than the marketing suggests. Third, and this one trips people up, confirm CDIC eligibility. CDIC ensures eligible deposits up to $100,000 per depositor per category. And crucially, TFSA deposits are insured separately from non-registered ones, so spreading across account types actually increases your coverage. The math on a 5-year horizon is stark. $20,000 in a big bank account at 0.05% grows to roughly $20,050. The same money at 1.5% grows to about $21,545. That's nearly $1,500 for doing absolutely nothing different except picking the right account. Here's where this gets especially important if you're freelance or self-employed. When your income isn't predictable, your cash buffer isn't just nice to have, it's your entire financial shock absorber. And most freelancers keep that buffer in a regular checking account earning nothing because it feels safer to have it accessible. Here's the thing. EQ Bank and Wealthsimple both offer high liquidity savings. You can move money out within 1 to 2 business days. You're not locking anything up. So there's no good reason not to have that buffer earning 1.5% tax-free while it sits. The strategy that the data supports. Keep your emergency fund, typically 3 to 6 months of expenses, in a TFSA HISA. According to the CRA, the 2026 TFSA contribution limit is $7,000, and your unused room carries forward. That means if you've never contributed, you may have up to $109,000 in total room available, depending on your eligibility year. Every dollar of interest earned inside that TFSA is completely tax-free. No T5 slip, no income to report, no CRA involvement at tax time. For a freelancer already navigating quarterly installments and self-employment income, that simplicity is worth real money. So here's the short version. If you want the highest, no-fee HISA rate and you're comfortable with a standalone digital bank, EQ Bank is the move. If you want your savings and investing in one place with no friction, Wealthsimple is the smarter pick for most freelancers. Either way, stop letting your emergency fund earn $1 a year. Links to both EQ Bank and Wealthsimple are in the description. Both are no-fee, CDIC insured, and TFSA eligible. The free 2026 Canadian Money Moves checklist is also in the description. It covers HISA strategy, TFSA room calculations, and more. Follow the Gain channel for weekly Canadian money breakdowns.